All right, it's 12 o'clock. We'll go ahead and get started. Good afternoon and welcome to First Western Trust Bank's 2021 Economic Outlook. I'm John Sawyer, the Chief Investment Officer for First Western Trust Bank. Thank you for joining us today, and I very much hope that you find the following presentation to be a good use of your time. A quick housekeeping note: the material presented today is based on sources believed to be accurate and subject to change. The comments are based on our opinions given current circumstances as of the presentation date. Nothing in the presentation should be construed as a recommendation to buy or sell securities. As each participant and listener is unique, the material presented could lead to different outcomes or impacts depending on your circumstances. Before making any financial decisions based on today's presentation, please consult your financial advisor. My co-presenters today are Karen Post, Managing Director of Equity Strategies, and David Stern, Director of Investment Research. I'll begin with comments about the election, the impact of COVID-19 or the status of COVID-19 and the U.S. economy. Karen will discuss the state of the U.S. equity markets, and David will follow with a review of global market trends. I will follow those comments up with concluding remarks, and we'll provide time for Q&A at the end of the presentation. If you do have questions, please use the chat function located in the lower center of your screen, and we'll get to those after we conclude our comments. So 2020 is behind us, and I'm sure many of you share my sentiment that I'm glad it's over and we're moving forward. Unfortunately, the impact of COVID-19 and the responses to it will certainly reverberate throughout 2021 and likely well beyond. And we'll get into many of the impacts of the response primarily to the virus, as well as the impact of the virus on the economy. But starting, I did want to just open with a comment on the recent election and the outcome of the election, as there is considerable attention focused on the impact of the Democrats now holding control of the White House, the House of Representatives, and ostensibly the Senate. So the majority that is held by the Democrats at this point is very narrow, and we tried to make a representation of that here just to really level set where we are with respect to control, as that seems to be getting a lot of attention with concerns related to legislative changes that may be forthcoming in the near term. On the left side of the screen, you can see the balance of power in the House of Representatives. Following the November 2020 elections, the Democrats held a plus 11 or 11 seat majority in the House. While this is a clear majority, it is notable that this is down meaningfully from the majority held in the previous session of the 116th Congress, where they averaged about a plus 37 seat margin. And so the results of the fall election for the House and the Democratic Party was actually not as favorable as expected, and not in line with some of the other outcomes in various districts. And so that is a fairly slim majority, and I think one also that will weigh on decisions about potential changes going forward for controversial legislation, at least, with the idea that midterm elections in 2022 are really not that far away. The Senate is really a different beast altogether. While it is a reasonable statement that the Democrats have control in the Senate, they do so with 48 seats on the Democratic Party, 2 independent senators, Angus King from Maine and Bernie Sanders from Vermont, and then the vice president who can vote in the instance of a tiebreaker. And so, if you see the list of names on the right side of this page, many of them are probably familiar to you. These are really moderate Democrats, I think, or centrist Democrats that are not necessarily going to rubber stamp any proposals that come down from a party line perspective. And so we do think that these relatively slim majorities will lead to much more moderate legislative agenda going forward. What we will see, and we got a taste of it over the weekend, is probably an active amount of executive order what we would expect, and has been consistent with comments so far, is that there will be a rush of executive orders in the near term that will unwind many of the Trump administration executive orders tied to the environment, the energy sector, as well as trade. So moving forward, from looking at COVID-19 and its impact and kind of where we are right now and then what we expect, the slide presented here on the left shows daily cases as well as mortality from the beginning of the virus early last year. And what we can see really beginning in the fourth quarter is a spike in infection rate, which is the blue line, followed by an increase in mortality rate, which is the green line in that left panel. This coincides with the widely discussed movement over the holidays. There was considerable travel that was an uptick over what we've seen over the past year, as well as family gatherings, et cetera. We've already seen those numbers begin to abate, and we would expect to see a return to kind of pre-holiday levels as we get into February. And then once we move into the spring with temperatures warming and more effective inoculation throughout the country, we would start to see more sustained improvements moving forward. The challenge, as many of you may have read or seen stories on, is noted on the panel on the right. Here, the green line represents the number of doses in millions that had been distributed to various states and local health departments, but the blue line represents the number of inoculations relative to those distributions. And so this remains a logistical challenge that needs to be faced. It's been a primary talking point of President-elect Biden with the intent of having 100 million U.S. citizens inoculated in the first 100 days. To do that, we'll need to see a pretty big uptick in the inoculation or vaccination rates versus what we have seen so far. As far as a timeline for broad country vaccination, this is the general timeline as put out by the CDC and coordinated with federal guidelines to various states. It should be noted that many states have augmented this to various degrees based on conditions and perspectives and needs within their various states. But generally, I think this four-phase approach is going to hold true. I think the issue that we're faced with because of the somewhat slower start in December and so far in January is the original expectation is kind of a May-June phase being into phase 4, or the late parts of phase 3 and into phase 4 is probably going to be later summer and into the fall, so September and October would probably be a best case scenario for those phases. The intent right now is still focused on frontline workers and then those, depending on your state, over 65 or 70, as well as citizens with morbidity issues that need to be addressed. And so we're clearly seeing the light at the end of the tunnel, although it's been a little bit of a rough start as we've rolled out the vaccination phase in response to the virus. Turning our attention to the economic conditions, the last year was a rather rough year, obviously, given the shutdown and the impact of the virus, but the response by both the federal government as well as the Federal Reserve Bank more or less met the needs to bridge the gap of the reduction in overall economic activity. Seen on this slide on the left is the fourth quarter 2019 GDP, and you can see we came in just under $20 trillion for 2019. And then the next column to the right was third quarter 2020. That's an annualized number from the third quarter economic activity measurements. And what you can see is we were down about 3.5% to $18.6 trillion, down 3.5% relative to the previous, or the close of 2019. What I think is very important to note here is the amount of federal stimulus that went into the economy that supported or likely supported that number. Without the $2.2 trillion in federal spending, it's likely that we'd had more or closer to a 15%, if not even more, frankly, fall in year-over-year GDP. And so that stimulus was very much needed to support the economy and bridge the gap. In addition to the noted stimulus plan in December, there was another $900 billion plan passed that should impact first quarter of 2021. And then President-elect Biden's proposal is a $1.9 trillion plan that equates to about 10% of GDP. And so these taken together should provide ample support, at least through the first, if not the second quarter of this year, as we begin to stabilize and move into a more sustained recovery phase. On the right side, I think it's worth noting that the 2008 TARP plan was about $500 billion, $500 billion, which would equate to about 3% of GDP. And so, it just puts into scale the enormity of the response that we have seen in reaction to the virus. What's not noted here, but I think is worth comment, is the Federal Reserve's balance sheet providing liquidity into the economy expanded by roughly $3 trillion in 2020. And so that would be another 15, 16, 17% of GDP that was provided in liquidity. There's obviously a lot of talk about the excess liquidity and the potential on inflation, and we will touch on that later in the presentation. We have noted here a few bullet points on Biden's proposed stimulus plan that you can read through. What you can see is that the bulk of this is really focused on maintaining a healthy consumer or helping maintain job levels where they are currently. As most of you know, about 2/3 or more of the U.S. economy is based on consumer spending, and so the focus of the stimulus plans has been on maintaining the health of that consumer, whether it's through payroll protection and maintaining employment or direct unemployment benefits to those that are impacted and displaced by the virus. The overall disruption of GDP is noted on this slide, and it is not only dramatic, it's really unprecedented, the fall off that we saw. And so, we have obviously entered a recovery phase in the latter part of this year. Once we got stabilization, and we saw really a dramatic turnaround in activity in the third quarter, we would expect to see somewhat improved and above trend GDP activity as we move into 2021, although we will likely see a slowing of that in the fourth quarter of 2020. Those numbers aren't out yet. The dotted lines that you can see here is really just showing if we had a return to pre-COVID growth rates, how long it would take to reach the end of 2019's level, and what you could say would be about middle of 2022 before we were back there. We did in all likelihood experience a slowing in the fourth quarter, and so it's yet to be seen kind of how quickly we will recover that. But our outlook for later in 2022, say that if not the first quarter, certainly the second, third quarter, and the latter half, is constructive, and Karen will address more comments on that related to equity earnings. And then the labor market, had really a mirror impact from GDP, and was significantly impacted. You can see the left line with the big kind of V or square root sign was the reduction in jobs in 2020 in the U.S. economy. The other lines noted here are previous recessions. The one in the middle that is kind of stretched out to 75 months on the right is the 2008-2009 recession. And what we're noting here is the months to recovery to regain those jobs that were displaced during the recession. This was really problematic during 2008. It got a lot of attention. It took the better part of 6 years to 5-6 years to recover those jobs. There was considerable scarring on the economy overall, and this was one of the contributing factors that really led to slower long-term, sustained but slower long-term growth in GDP overall in the United States. As you can see, the most recent month of job gains was actually a loss of 140,000 jobs, the non-farm payroll report in November. The unemployment rate held steady at 6.7%, but we do see a continuation of that slowing right now, although we think that will pick up once the stimulus money and the next round of stimulus is passed, gets into the economy. In the middle of the chart are a couple of panels that demarcate how long or how many jobs per month need to be added to recover those that are lost. And what you can see is that we have a very, very steep hill to climb. So even to recover the lost jobs over 4 years, or 3 to 4 years, we need roughly 200 better thousand jobs a month to be added to the economy. To put that in perspective, in 2019 we added 171,000 jobs per month, so that sounds close. The unfortunate challenge is that we would need 200 to 250,000 jobs a month in addition to that average run rate, and so we're looking at 2x or better in a sustained fashion just to recover the lost jobs in 4 years. We need roughly 100,000 or more jobs a month just to maintain new entrants into the job market, and so absorbing the displaced increases the need for more jobs to be created to really help stabilize the job market overall. Of note, there's really been focused and concentrated losses within various sectors of the employment picture across the United States, and obviously, as widely reported, the biggest impact within leisure and hospitality, where you can see only about 55% of those jobs have been recovered. Education also meaningfully displaced, as well as professional businesses. And then to the right, you'll see government. It's one of the few areas that has a meaningful decline in jobs, not a recovery. And that is one of the points of Biden's proposed stimulus plan, is to provide a significant amount of money to state and local municipalities to at least stem that flow, if not to provide some support to bring those employees back online. One of the encouraging aspects of this slide, if you can find one, is the impact in the leisure and hospitality aspect, and that it's a very reasonable outlook that we have considerable pent-up demand from the consumer to participate in leisure and hospitality activities, and that what we would expect is once we get reasonable vaccination rates, that we will get a rapid reopening of the economy, and that those jobs will recover at a faster pace than probably the other segments that are noted on this slide. Turning to interest rates, this has really been a focus in an area that was meaningfully disrupted starting in March of last year. On the left panel, you can see the bottom blue line. That is the end of the year yield curve, December 31. Rates are up a bit in the intermediate section since then. And then the middle lines show December of 2019 and December 2018. And what you can see, even moving into the end of 2019, is a steady progression of lower and lower rates as we moved into the kind of pandemic of 2020. The bright side of this slide, as many of you that we've visited with before will know, we're quick to talk about this, is that at the end of 2019 and the end of 2018, you can see the yield curve was what we call flat, and that there wasn't much slope to that from the front end on the top line of 2.4 all the way out to the 30-year at 3%, with a 60 basis point differential between the front and the back of that yield curve. What we can see in the current yield curve at the bottom is a steepening of that curve, and it's even steeper now with the 10-year now above 1%, which is very constructive for the financial segment generally, and banks in particular, in that supports better and more robust net interest margin, which does encourage banks to provide more liquidity and lending to the economy overall. One of the things that we've talked about for really the past couple of years is the challenge the economy would have if banks did not see the opportunity of lending as a profitable endeavor, as that would choke off liquidity to businesses, which would have the impact of slowing the economy overall. The steepening of this curve we find to be very constructive in that it should keep bank lending and banks very involved in the economy. The right side is simply another way to represent that steepness. What's shown in the right panel is the spread, or the difference between the 2-year Treasury note and the 10-year Treasury bond. And what you can see is throughout 2020, we've seen meaningful steepening in that curve from almost zero to about 80 basis points here recently, and so that's a much improved lending environment overall, and we think is constructive as we move forward. As I noted earlier, one of the primary concerns that's been coming out of the really unprecedented amount of stimulus is the potential impact on inflation. The left panel here charts PCE, which is the Federal Reserve's preferred measurement of inflation. What you can see is that while it has been erratic over the period shown here since 2010, it has really been quite subdued for the past decade. The Federal Reserve has been very clear in their target of maintaining a 2% inflation rate in the economy, and they actually recently changed their outlook, and they kind of evolved their outlook, if you will, from 2% to a range or an average of 2%, indicating that they would allow the economy to run at a higher than 2% inflation rate for some period of time to make up for periods where we were below that. It should be noted, despite the concerns related to potential inflationary pressure due to all liquidity, that the U.S. Federal Reserve and frankly central banks around the world are still more concerned about deflation and disinflation than they are inflation, which is why we've seen such accommodative postures really globally from central banks throughout the crisis. I think it's also worth noting that the average 10-year of the PC series is 1.6%, and so what you can see is we're really nowhere near maintaining that 2% growth rate or inflation rate that is the Fed's target. The other challenge that the Federal Reserve has, and I think supporting their intent related to lower for longer and maintaining the 0 to 25% Fed funds rate probably well into 2023, if not beyond, is that they are burdened with a dual mandate, which is to maintain price stability. One measure of that is on the left panel there, and their focus on inflation. But the other side of that equation is to maintain full employment. While they aren't really clear on what defines full employment, the widely kind of accepted definition is about a 4% unemployment rate. Right now we're at 6.7%. And so, until we start seeing higher inflation coupled with a return to at least below 5% unemployment, it's unlikely that we're going to see that Fed funds rate move, which will support a continuation of a steeper yield curve. The other thing to bear in note, that does not mean that the Federal Reserve does not have tools in the tool chest to address a changing economy. They obviously are maintaining a considerable and robust pace of purchases, bond purchases, and adding to their balance sheet. And so probably the first real change that we'll see as they become more comfortable with the sustainability of the recovery or moving into an expansionary phase is a reduction of those purchases. Despite those comments about inflation, though, I think it's really important to think about where the liquidity is going and what the impact of that liquidity is. And I do think that within the context of concerns around inflation, the true impact is being missed by most commentators. The right panel shows the appreciation in prices. The Case-Shiller index in the light blue represents the housing market. The gray series is gold, and then the dark blue, we're using the symbol is TLT. It is the long-term Treasury ETF, so it is a price representation of what longer-term bonds have done over the past 10 years, as opposed to yields falling, obviously, as prices rise. And so what you can see is that liquidity that came into the market, whether it be from the '08 response to the housing crisis or the more recent response to COVID, has supported higher and higher asset prices. And that inflation, that liquidity really continues to push those prices higher. And it's one reason that we feel that valuations, while always notable and worth watching, may not be quite the red flag that they historically have been, because of both the liquidity coming into the market as well as the really historic lower rates that we see right now. And so I'm going to conclude there and turn over to Karen Post, who's going to give us some comments on U.S. equity markets.
Great. Thanks, John, and good afternoon, everyone. So starting with valuations, most measures that investors use to gauge whether the stock market is cheap or expensive all pretty much show that the market is expensive. There's no doubt a lot of good news is already priced into the stock market, and so it is a very valid point of concern for this year. This chart shows the most common valuation measure, that of the S&P 500 forward 12-month PE ratio, and that's just simply the price of the index over the forecast of earnings over the next 12 months. And you can see on the graph, currently the market is trading just under 23 times forward earnings, and that's quite a bit above the historical average of about 17 times. And it's also near the peak that we reached in the tech bubble of about 26 times. But I would say multiples in part are driven by where we are in the business cycle. And so back in the tech bubble, valuations reached their peak right before we were heading into a recession. This cycle has been a very unique cycle in that it was a shock to the system, driven by the pandemic and the lockdowns that then occurred, that really hit the market. And so we've come through the collapse in the multiples last year. Last year at the beginning of the year, multiples were at 19 times. By March, they had fallen to 13 times, and that was the low for the year. But since then, multiples have expanded quite significantly because investors kind of look through the worst of the pandemic, and we're anticipating a quicker recovery than you would normally see in a traditional recession. Now, I don't think it's the end of the recession has been officially called, but you would expect to see that shortly, and especially as GDP growth ramps up this year. The other sign of perhaps excessive investor optimism that is out there is just more qualitative. So you have investor sentiment surveys that measure the percentage of bulls versus bears is very high. The IPO market last year hit record levels and continues to be quite strong this year. The popularity of stock trading platforms like Robinhood have exploded, and bringing more and more individuals into the market. And then finally, you have the concerning behavior of stocks like Tesla, which has risen close to 50% since the end of November when it was announced it was being added to the S&P 500. But what I would say, though, is valuation in and of itself is a very poor predictor of equity returns, especially in the short term over a one-year period. There's virtually no correlation between valuation and returns. And in fact, it's very hard to find anything that correlates with one-year returns, given there's just so much noise so many other factors that can drive the market. Valuation is a better predictor, though, for returns in the long run, say over a 10-year period. But overall, from here, we would expect multiples to compress this year, just given the elevated levels, and they typically do kind of in a second year of a recovery as earnings start to rebound and should be the primary driver of equity returns. Turning to the next slide. So interest rates are also an important driver of valuation, and the one measure where stocks still look attractive is relative to bonds and rates. And these charts show the S&P 500 earnings yield versus the 10-year Treasury yield. And the earnings yield is just the inverse of the PE ratio, so it takes the earnings over the price of the index. And the chart on the left, the blue line being the earnings yield and the green line being the 10-year Treasury yield, shows that when the blue line is above the green line and the wider the gap, the more attractive equities are to bonds. And the chart on the right just depicts this a little differently. It's plotting the difference of those lines as a bar chart, but really shows that the spread is still quite wide, especially compared to the last 17 years, and especially in contrast to the late 90s and early 2000s, when equities were actually yielding yet less than the Treasury yield. The risk, though, is that interest rates rise too far and too fast, that they become a threat to valuations. Rising rates in and of itself aren't a huge problem if they're rising for the right reason. So if it's for better growth, or if it's the economy just reflating as we think it will this year, then equity should be fine. But if interest rates rise too quickly, it could be a sign that perhaps investors see inflation and not just reflation on the horizon, and that could cause some disruption in equities. And also, you've seen periods like back in 2013 when the Fed pulled back too quickly on their asset purchases, called the taper tantrum, where rates rose very quickly over a short period of time, and that did cause equities to correct. But other than rates and where we are in the business cycle, obviously earnings and growth is also an important outlook for equities. So John, you can go to the next slide. And so unlike equities, we think corporate fundamentals should be a bright spot this year. And here we're looking on the left chart, the quarterly growth in earnings per share for the S&P, and on the right side, the revenue growth. The blue bars being the actual historical growth, and the green bars being what the forecasted growth is. And as you can see, the pandemic really hit corporate profits hard last year, with second quarter being the hardest hit. Earnings were down over 30%, and revenue was down close to 10%. But since then, things have rebounded quite quickly, and we're seeing sequential improvement in corporate profits despite the continuing impact of COVID. And in part, that's because of the massive stimulus that we've seen. It did provide a very big bridge to the consumer. And then also businesses were just very resilient and adapted quite well to the changing environment. So much so that in the third quarter of last year, if you exclude energy, airlines, and the travel sectors, earnings growth was actually positive. So that's quite a big achievement for corporate America. And I would say, though, that the improvement we're looking at S&P 500 here, so it's the bucket of kind of larger companies. Obviously, smaller cap companies perhaps didn't fare as well. Looking forward for the full year this year, earnings growth is expected of over 20%, and earnings could reach new highs above 2019 levels. So a very quick recovery in earnings. And again, that just highlights the unique nature of the pandemic and also the massive stimulus that we've seen. You can go to the next slide, John. Another topic that equity investors have been debating has been growth versus value. And this chart shows the difference in returns between growth stocks and value stocks. And you can see from the big hockey stick on the right that growth stocks have outperformed significantly over the past year. And in part, that was driven by the unique nature of the pandemic. And really the classification of growth versus value is defined by index providers, and they have their own certain set of rules of how they classify them. This is, rules as set out by the Russell 1000. Going forward, though, given the outperformance of growth, you could see a period where value does outperform. Value typically outperforms when the economy is reaccelerating. But once the market moves past the virus, and returns to kind of a below trend or kind of trend-like lower structural economic growth, we would think that growth, over the long term should do better. Another way to frame, though, this discussion is cyclical versus defensive. So, value can be defined by investors quite differently. But in this environment, given the unique nature, we think cyclical stocks, which can be value or growth, for instance, banks are considered value stocks, but we think banks should do quite well in this environment. But cyclical growth stocks, such as semiconductors and technology, should also do well. More defensive areas, such as consumer staples, which did very well last year, and utilities might lag for a while until the economic balance moves on. At First Western, we kind of frame things a little differently. We don't look at the universe growth versus value, but we're rather looking for intrinsic value in stocks. We're looking at the future cash flows that a business can generate and comparing that to where the stock price is. So, we buy stocks for the long term, and we're looking for stocks that can generate long-term shareholder value throughout a cycle. Next slide, John. So just some other considerations to wrap up. Obviously, with a new administration can come a slew of new policies that can impact different sectors positively or negatively. Some of the highlights that we think we could see an impact are in infrastructure. There's seems to be clear bipartisan support for an infrastructure bill, and that could be anything from providing universal broadband to rural areas, updating the electrical grid, and just rebuilding roads and bridges. Clean energy obviously will be a big area of focus. You could see higher tax incentives for green energy and renewables, whereas traditional oil and gas could see tighter regulations. In healthcare, we don't really see big sweeping changes in healthcare policy, although you could see an appetite for restrictions on drug price increases or allowing Medicare to negotiate drug prices, which would, obviously impact pharma and biotech companies. And then finally, just on the broader tax policy, I think Biden's proposal is currently to raise the corporate tax rate from 21% to 28%, to impose a minimum rate on all corporations, and perhaps some other Social Security payroll tax changes. And all of that would certainly be a headwind to earnings in 2022. I know that's a long way off. But with all the stimulative spending programs that could potentially get passed, you could just see them kind of offset each other and be a net neutral to equities. But just something to bear in mind. And obviously, as we move through the year, there'll be more focus on that by equity investors. And with that, I'll turn it to David.
Thanks, Karen. Good afternoon, everyone. I'm going to take the next several minutes to discuss the international markets, specifically global economic activity, trends in global interest rates and the implications thereof, and then I'll wrap up with the performance of international equity markets at the end. And I think what you'll find is that the topics and factors that John and Karen have discussed with respect to the U.S. economy and U.S. equity markets are, in fact, very relevant to those in the international space as well. If we look at the next slide here, what we're showing is a heat map of global PMI data. And just to define some terms here, PMI is Purchasing Managers Index. These are survey-based indices. And what these numbers here are capturing is a composite number looking at both the manufacturing and services sectors for various countries and regions around the globe. As far as how you interpret the numbers, those above 50 are indicative of economic growth, whereas those below 50 are indicative of economic contraction, and numbers in the 40s are typically associated with recessionary periods. So what you see here as we look at the table moving from right to left on your screen, we entered 2020 in a pretty good place, right? If you look down the column of January 2020 values, you'll see that they're all above 50, indicating that we were experiencing broad economic growth across these various countries and regions. Then as we progress into the first quarter, you can see that economic activity came almost to a virtual halt almost overnight in the face of the rapidly spreading coronavirus. And you can see in April 2020, in fact, that a lot of the numbers were in the teens and low 20s, and that is remarkably low, especially given the fact, as I just mentioned a moment ago, numbers in the 40s are typically considered recessionary levels. Then as we move through the second quarter, towards the end of the second quarter into the third, you can see that we generally had pretty good recovery in the numbers. And in fact, we're generally back into the green during that time period. Of late, what you're seeing, especially in the developed market regions, is more of a slowing, right? We've seen some moderation in the numbers in the face of a second wave of viruses, and as countries take steps to try and stem that. And so as we enter 2021, it's a little bit of a mixed picture, with emerging markets doing a little bit better than developed markets, but we would anticipate as we move through 2021 that developed markets will again return to growth as we continue to rein in and get a handle on the coronavirus. If we turn to the next slide, this is just looking at global economic growth at a higher level. This is GDP, whereas the last table was PMI data. And you can see obviously that 2021 was a very difficult year, really across the board. Global economic growth is forecasted to ultimately come in at -4.5%, led by the European or the Eurozone down close to 7.5%. The US on a relative basis is expected to do a little better at down -3.5%. The one outlier on this chart I would point to is China at 2.1%. And actually, as of the reporting of their fourth quarter GDP yesterday, we now know that that number, in fact, was 2.3%. In a relative sense, obviously, that's a good number. It's obviously a positive number. And here in the US, we would be happy to be able to report 2.3% growth for 2020. But in the context of history, that is a very poor number for China. In fact, it's the weakest number going all the way back to 1976, when they recorded -1.5% growth that year. And just to juxtapose that 2.3% growth to the financial crisis, China during 2008 and 2009 recorded GDP growth of 9.5% in those years. So again, it's a positive number as you look at it on the screen, but the on-ground effects are every bit as recessionary there as our -3.5 was here. If you look at 2021, you can see that the numbers generally improve. That would be expected. We do expect a healthy rebound in 2021 as economic activity rebounds. But I think it's really best to think of that in terms of a rebound and not some new sustainable higher run rate, right? As we see it, and you really see that reflected in the 22 numbers where you get more of a moderation. We don't see anything afoot right now that points to some sort of structural rebasing to a higher level with respect to economic growth post the rebound in 2021. So said differently, we are going to see a nice pickup in 2021, but then we expect in 2022 and beyond that growth rates will moderate back more in line with the run rates that we were seeing pre-pandemic. Again, I'll just note China here on this slide because it is, or in these timeframes, because it is a little bit of an outlier, going from 8.2% in 2021 to a forecasted growth rate of 5.5%. If you look at the longer term growth rate of China since 2010, this is very much in line with a deceleration that we've been seeing over that time. In 2010, China reported economic growth of 10%. In 2019, it was down to 6%. Spending projects, increasing debt levels, and cheap exports to one that resembles more of the U.S. Economy, where the consumer is the leading driver of growth. And so that 5.5% down from 8.2% looks significant, but again, is very much in keeping with the trends that we've seen over the past decade. Turning to the next slide, John and Karen at points touched on lower yields and the implications thereof here in the US. That's not a phenomena unique to the US. What we're showing here are the yields on the 10-year bonds for various countries in Europe. And you can see that there too, there's been a steady deceleration or reduction in those yields over time. You can see now that Germany and France both have negative yields on their 10 years. France and Italy are getting close. They're not quite there yet. However, if you look at the two-year bond, for those four countries, it's negative across the board for all four of those countries, anywhere from negative 35 basis points to negative 70 basis points. That compares to about a positive 13 basis points here in the US, which on an absolute basis may be nothing to write home about, but certainly on a relative basis is far more attractive than what you're seeing in Europe. On the next slide, we've included Greece because I wanted to make the point here that this reduction in yields has been very broad-based, right? Not necessarily reflective of trends in just the better credits, if you will. If you think back to 2012 and 13, at the depths of the European debt crisis, there were real concerns about the solvency of Greece, right? And that's reflected in the interest rates that we see here on this graph, where they spiked to the mid-30s, but since then have dropped precipitously. Their 10-year today is yielding just under 70 basis points, whereas ours is at 1.1%. So they too have kind of caught the wave, if you will, in terms of lower interest rates seen across the continent of Europe. And in fact, their two-year, the yield on their two-year note today is about a negative 13 basis points. And again, ours is close to a positive 13 basis points. So just remarkable compression in the yields that we've seen there. Turning to the next slide, this really captures the absolute amount of negative yielding debt across the globe, beyond just Europe, but globally. And you can see here at the end of 2020, we were at a new record high of about 18 trillion. As we look into next year, we do think that perhaps this number moderates. I don't know that it's in a precipitous manner necessarily, but as we see improved economic activity, or certainly the expectation thereof, it would be our expectation that rates at the longer end of curves will begin to increase. And in fact, we've seen that of late here in the US. So as rates at the longer end of the curve begin to increase, and in some cases for countries move back into positive territory, probably this aggregate global number decreases. However, remember that it's the market that has the greater influence on yields at the long end of the curve, whereas it's central bank activity and monetary policy that has a greater influence at the short end of the curve. So again, with the expectation of accelerating economic growth, we may see this number moderate some in 2021, but again, I wouldn't expect it to be a precipitous decline simply because of the demonstrated commitment that global central banks have made to keeping monetary policy very easy and thus rates very low. Moving on to the next slide, I think this does a very nice job of succinctly capturing a lot of what we talked about, again, what John touched on, what Karen touched on with respect to valuations and just the impacts of lower interest rates and what the effects have been on financial markets. What we're showing here in the blue is the Msci All-Cap World Index. And so that is an index that reflects 23 developed markets and 27 emerging markets for a total of about 85% of the global equity investable opportunity set. We're showing its price level on the left. And then on the right-hand axis, what we're showing in an inverse fashion is the yield on the global aggregate bond index. And that's just a very broad measure of the global bond market. And what you can see here is as global yields have declined, you have generally seen an increase in global equities. And it's not perfectly linear, things rarely are, but directionally, we have certainly seen a rather meaningful correlation between that decrease in yields and that increase in the price levels. Given where rates are currently, we would generally expect this to kind of continue. Now, there's not a lot of, you can have a debate around how much lower yields can go. But generally, we expect that they're going to remain at a low level for the foreseeable future. And so with that, you'll continue to see that supporting equity markets as we move into 2021. And then just to conclude, if we move to the next slide, obviously I think we're all very familiar with the frankly surprisingly strong returns that we saw here in 2020, here in the US in 2020, especially with everything that took place. But international markets also enjoyed relatively strong returns in 2020 as well. And so what we're showing on the left-hand side of the screen is the Msci EFA index on the far left of that chart. And that's really just a broad measure of how developed markets performed. And then to the right, you have individual countries representing the largest constituents in that index. And then on the right-hand side of the page, we have basically the same information for the MSCI Emerging Markets Index. Again, looking at its year-to-date performance in blue, its quarter-to-date performance, that would be the fourth quarter of 2020, and then the performance of the top constituents in that index. And again, you can see pretty much across the board, we saw solid positive returns last year, capped off by a very strong fourth quarter, giving us some momentum as we enter into 2021. So, as far as the international markets are concerned, as we turn the page to 2021, we continue to see a lot. We expect to see a continuation of the trends that we saw at the last year. But obviously, 2021 is going to be all about the distribution of vaccines, very similar to the story here in this country. And we expect to continue to see yields remain relatively low due to the commitment on the part of central banks to keep rates low. And so that's with rates low and liquidity levels high, we think that provides a positive backdrop for international equity markets in 2021. And so with that, let me pass things back to John for some concluding remarks.
Thank you, David. Thank you, Karen. In conclusion, I hope you take away that we are cautiously optimistic as we enter 2021 and really looking beyond into 2022. That's really based, despite very high valuations, based on the fact that we have substantial stimulus still coming into the markets, both in the U.S. and globally, paired with historically low interest rates. We think both of these are supportive of the recovery and then moving into an expansionary phase. The real challenge will be tying those stimulus programs from a recovery perspective to improved and sustained organic growth in both the U.S. and global economies, and that is yet to be seen. But because we think there is so much pent-up demand and supply, frankly, within various economies and regions, we do think that we should see a pretty good convergence as the stimulus programs wear off, that overall real growth takes over and stabilizes the global economy and the U.S. economy both. So from a domestic perspective, we do see a continuation of the recovery. We do expect, and David noted on this a bit, to have above average GDP growth, certainly in the first half of 2021 and possibly into the third quarter, but see that stabilizing as we move into the latter part of this year and moving into 2022. And we do see at that time, say in 2022, a return to the pre-COVID overall GDP growth numbers around 2.5%. We will also likely see varied inflation this year, and I think this is something that investors need to be mindful of, in that we are likely to get some fairly erratic numbers, especially as the economy starts to open up, and that should not lead to the conclusion that we've moved into a sustained period of higher inflation, but one that is probably due, again, just to reacceleration and adjustments to overall large amount of pent-up demand, which would likely stabilize by the end of this year. We do anticipate interest rates remaining lower for longer, in line with the Federal Reserve's guidance, but also to David's point, and it's a very good one, while the Federal Reserve controls the front end of the yield curve, the markets really control intermediate and the longer end. And so we could see a situation that if there's widespread market belief that we're moving into either a sustained higher growth period or a period of sustained higher inflation, that those intermediate and longer term rates could move up in a more dramatic fashion and force the Federal Reserve's hand to start moving short-term Fed funds rates higher. As Karen noted, we expect equity markets or equity earnings to rebound, which should help with current valuations, which are obviously elevated. We expect to likely reach record earnings by the middle part of 2022, and that should help alleviate some of the concerns that we have right now related to those higher multiples. And then, obviously, beyond just inflation and earnings, we're going to see erratic market and economic series really in the first half of this year. And so we do caution investors to not be very reactive to short-term changes month over month or quarter over quarter, and really work to divine what is the trend within those numbers. And then finally, we expect in concert with the U.S. recovery that we will see overall global recovery and acceleration, frankly, as we move into the year. And so we are constructive on foreign markets as well as the U.S. That said, I will just touch on the U.S. dollar, which has been notable in its depreciation over 2020. We don't necessarily see a continuation of that, although it's something to watch closely. David touched on the amount of debt that is now globally that's now negative yielding, and that differential between U.S. rates and foreign rates, especially in Europe, is meaningful and should continue to drive interest and demand from foreign buyers for U.S. Treasuries, which has the effect of supporting the dollar. So we do not see a continuation of that weakness, at least in the near term. All right, with that, we'll move into the questions. I'll just remind you, if you have any questions, feel free to use the chat function in the bottom center of your screen. I do have one that's probably geared towards Karen, but I'll take a stab at it. For someone with excess cash, how do you rationalize entering the market right now with valuations at all-time highs, and where do you think the best investment opportunities lie? So I'll give two answers to that, and one that's probably not very helpful, and then one that perhaps is. I think the standard answer to that, and while you may not feel it's helpful, I do think it is important to bear in mind, is that we should not be investing in equities for near-term performance. It is a long-term asset that inherently has a high degree of volatility, and we really seen that over the last couple of years, although we've seen it to investors' favor, but markets are as likely to show us the other side of that. From a long-term perspective, the valuations are perhaps not as worrisome, but if it's a near-term outlook that you're looking for, then they could be, despite the low rates. And so it's probably a cautious time relative to that for someone with a unduly short time horizon that's looking to equities as an investment. Where do you think the best investment opportunities lie? I think this goes to Karen's point and speaks to valuations as well. The valuations that noted here are for the S&P 500 at large, and those are impacted significantly by some of the larger cap tech names. And so as you move into the broader equity space, what you'll find is that the valuations are not quite as nosebleed levels as what we see on a lot of the tech companies right now. And so there's ample opportunity within the broader market to find equities that we feel are underpriced. To Karen's point, we're obviously always looking for companies that have higher intrinsic value than current market price, and we feel that we're still able to populate a portfolio with those names. So Karen, I probably took any talking point you might have, but if you want to add any.
I would just add that there are opportunities kind of beneath the surface, and that the broader index is influenced, as John said, by the rising concentration of the top 5 tech names. And one thing that investors talk about is dispersion. And if you look at the difference between the group of the highest valued stocks and the group of lowest valued stocks, the dispersion or the difference between the two is the widest that it's ever been. So there's a lot going on underneath the surface where you can find opportunities to invest.
Great, thank you, Karen. One more that I'm going to take a stab at, just because it's a topic that continues to bother me, and I watch closely, and I know it bothers many of the listeners here. How long can the government continue to finance expenses by adding debt to their balance sheet? So, this is really a great question, and I think it's one that's center to a lot of conversation and thought currently. We have expanded the amount of federal debt at a very rapid rate. We're now at or above 100% of GDP, which is effectively unprecedented in our history. And I think the expectation is, if not 2020, 2021 will exceed the rate seen the previous record, which was after World War II, but not paired with an event as much as potentially sustained spending, which obviously could be problematic. I think the issue to think about here, one side of this is the absolute debt value and how much is outstanding. The other aspect is the cost of that debt. And what we see right now, because rates are so low, the cost of debt or the interest expense of the government as a percent of GDP is not really near record highs, so more in the order of maybe 2% or 1.5%. We've seen that go much higher, even in recent decades. In the early 90s, I think we were over 3% interest expense to GDP, with much lower absolute debt values because overall interest rates were higher. I think that the thing that maybe is maybe two things that are more important to think about is, one, or the warning flag would be, one, when the continued borrowing is, requires higher interest rates or cost to borrow. So that would certainly be a signal that the market is becoming concerned with the absolute amount of debt that the U.S. government has. But also the sustainability, if and as rates were to rise, if we were to move into a period of higher interest expense relative to overall GDP or as a portion of the federal government in general. Thinking back to the early 90s when we approached 3 or 3.5%, that was really at least a factor, if not a catalyst, for George Herbert Walker Bush's kind of about face on taxes, and to kind of break his pledge of no new taxes, and to address the debt limit and the spending. And so right now, in line with my earlier opening comments about where the balance of power is in Washington, we do not see any significant legislation or disruptive legislation in 2021. But were the interest rates to become more problematic and a bigger drain on the budget, that could be an issue that forces reconsideration of potential tax changes overall. And so it is a topic that's worth watching closely, as we're really in kind of unprecedented territory. But right now, it does not seem to be an issue that's inhibiting the government's ability to borrow. So with that, we'll wrap it up. I want to thank everyone for attending. We appreciate you being here. If there's anything that we can do for you, please don't hesitate to reach out. And I hope you all have a healthy and safe afternoon. Thanks, everyone.